Okay, everyone, we're going to get into talking about budgeting and financial management principles. Um, and what I want to start off with just noting, regardless of what industry you're going to find yourselves in, because many of you may not find yourselves in the healthcare industry, but regardless of what industry you do find yourself in, budgeting and understanding a budget and how to create it and how to understand your finances is probably going to be one of the most powerful tools you're going to have as a manager, supervisor, administrator. And once you really understand what it is and how you can make it work for you, it's going to tell you a lot of information about your organization. It's going to tell you things like, are you having personnel issues? Are you having supply issues? Are there some serious things going on within your organization? And we learn all that through understanding a budget and understanding how to use it. Now, through this module, we're going to give you a basic overview of budgeting, but I would highly recommend, if you haven't already, to take some type of budgeting class to just better understand budgets, not only for the organization that you may be going to work for, but for your personal use as well. So these are some basic terms regarding a budget that we're going to be talking about throughout this particular module. So we'll start, just with revenue and expenses. Revenue is all of your inflow of cash and money into the organization. Expenses, of course, is all your outflows. And when you really think about it, a business in its simplest terms is nothing more than just revenue and expenses. What's coming in, what's going out. Now, if we look at our non-monetary terms, when we start with labor hours, this is generally just how many people are working. What does your work staff look like right now? When we get down to the hours per adjusted patient day, so we're back, talking about healthcare in particular. When a budget is written and when it's created and put together, it's really written by the revenue coming in. And it's defined in the form of customers, or in our case, in the form of patients. And we base our budgets a lot off of patient days, which sometimes you may hear this called PPD, per patient day. So for example, let's say we have budgeted 3.5 nursing hours per patient per day. So if we let's make the math simple and say we have a facility that has 100 beds that are all occupied, all staffed. We take that 3.5 hours that we have budgeted, multiplied by how many beds we have, which would give us 350. We take that number and multiply by the days of the week, 7, that we're going to staff for, and that's going to give us almost 2,500 nurse hours for the week that we're looking at. And then some other non-monetary terms that you're going to hear: quantity of services, and then number of employees. So this is really the reason that controlling and planning are so intimately connected with each other. You almost can't do one without the other. So if we start there at step 1, just setting our goals, we're really setting based on the revenue that we expect to be coming in. So as we kind of move along the path, when we're determining fixed and variable costs, just note that fixed costs, they're not going to be related to patient care. So these are things that are going to be like our light bill, anything that's not related. It's not going to change because of the amount of patients that we have in the hospital. So it's not subject to change with the volume of patients that we have coming in. Whereas variable supplies are subject to change. If we have a large volume of patients coming in, we're going to be using more labor hours, we're going to be using more supplies, but then the next quarter, that patient volume may go down, and so that variable cost is going to change in terms of how many supplies we're using, how many labor hours we're using. So understanding budgets, the first thing to understand, not all budgets are going to be the same, and it's going to vary from organization to organization. But typically what we see is budgets, organizations are going to use budgets that cover a 1 year time period. Now, some are going to cover quarters, and some may use that quarter budgeting because they want to take a closer look into what's going on within their budget. But typically what we're going to see are budgets covering the span of 1 year. Now, these are called fiscal years, and fiscal years usually run not like the physical year, which would be January through December. Fiscal years usually run July 1 through June 30th of the following year. So they start about mid-year and run till about mid-year the following year. And when we start to make out our budgets, we're going to go historically and look what the trends have been in previous budgets. And we're going to use that information to make plans out for the new budgets coming up. So using that historical information that we go to pull to kind of set our future direction in terms of our budget. Now, who relies on budgets? This is going to be every level of management needs to be familiar with the budget, and it's going to be very essential to strategic planning and overall management of your organization. Now, there are a couple types of budgets that I want to make sure that you are familiar with, so make sure that you are familiar with these. You are going to see them again probably on a test. But we'll start with the operating budgets, and these are really our primary budgets, and what we're saying here, what this budget is saying here, is generally just this is what we're making, this is what we're bringing in, and this is what we're spending. Now, when we move on to capital budgets, we have a separate capital budget aside from our operating budgets because capital expenses, which are things like equipment, buildings, your very, very large expenses where you're going to be spending a large lump sum of money all at once on one thing, one piece of equipment, one building, they actually have a different tax structure, and they go through something called depreciation, which we'll go through later. But we do have a separate capital budget. And then the third type of budget is the cash budget. And what we're saying here is this is the cash that we have on hand for the organization. And it is a separate budget from our operating budget because a lot of organizations work on accrual-based accounting. And why do we do accrual-based accounting? Well, if you think about how billing works for an organization, if you currently work for a healthcare organization now, or if you've been to one and have received bills, you bill for the time of service. So you may have an office visit or a hospital visit in October and receive the bill for that service in November, and we typically see the 30-day turnaround time for payment or for billing, and then additional for the payment out where we receive the money later. So a lot of organizations are going to find themselves working on accrual-based accounting principles. And guys, everything is going to come back to dollars. Everything's going to come back to money because like we've said several times, and particularly at the beginning of this class, although healthcare does have very altruistic beginnings, we're here to help people. What people often forget sometimes is healthcare is a business, and we've got to conduct activities to help keep the doors open so that we can continue to provide those services. Now, managing the budget is going to make up a good portion of what you're going to be doing in your primary responsibilities as a manager, because your budget is essentially your financial plan, either for your department or for your organization. And this managing function for the budget is going to help you and set you up to start IDing or identifying variances in the budget where you're over budget or under budget and the reasons for that over or under budget, and help you to do some real-time problem solving so that you can get to the bottom of why were you over budget on your salary expenses this past month, or why were you under budget on your revenue? Is something going on that you need to investigate a little more closely? Now, just like everything else, budgeting does have its drawbacks, but there's not enough, or it's not anything significant enough to change the way we budget. Budgeting is a fantastic thing that's really going to help you as a manager or as a supervisor administrator, and it can help you in your personal life as well. So, you know, one of the complaints of budgeting that we often hear is just that the concept is so hard for some people to understand sometimes. Well, think back to earlier what we said a couple modules ago about what is the job of the manager. Essentially, you know, you do wear a lot of different hats, but one of those is being a teacher. Your job is to continually help your employees and your staff professionally develop themselves. So your job is to teach your employees how to do this budgeting concept. Teach them how to manage a budget. You may not only be helping them understand the budget for your organization, but by teaching them, you may be helping them, you know, even in their personal life. So budgeting is not a bad thing. It is a little time consuming. But again, there's not any significant drawbacks that would warrant us not to budget. So here's an example and a very basic and simple example of an income statement. So you're going to see we have a couple of different categories broken out: revenues, operating expenses, and net income. So under revenues, of course, we're going to have all the money we're bringing in, which in this case, in this example, is $3,900. And then our operating expenses, everything related to the operations of the business. So this is things like rent, your salary, and in this case, it's going to add up to $1,700. Net income is going to come from simply subtracting the total expenses from the total revenues to give us about $2,200 in net income. Now, sometimes on income statements below this net income section, you're going to see another section. It's either going to be called net operating income or NOI, or you may see it sometimes, particularly if you're in a for-profit setting, called EBITDA. That's EBITDA, and that stands for earnings before interest, taxes, depreciation, and amortization. And listed under this is going to be things like your amortization schedule if you're paying off loans, your depreciation schedule if you have bought capital equipment and that capital equipment continues to depreciate or lose its value over its useful life. So those are some extra things you may see or may come into contact with on the income statement. Now, a balance sheet is really looking at what an organization owns and what it's worth at any given point in time, and what it owes, what are its debts. So here we have our assets, liabilities, and equity. We can see this is for the period ending December 31st. And we can see, you know, we have a couple current assets in terms of cash, accounts receivable, and other assets. And then we have some more long-term assets in terms of property, plant, and equipment. Things we owe on are liabilities, so we have bills and expenses that we have to pay out, some short-term debt, long-term debt, and then any equity that we have revolving around our earnings or stock options. And again, a very basic cash flow statement, and I'll go over this just briefly, but this is going to show the cash on hand for the organization. So you can see we start here in January. This $1,000 probably came from the previous year's month ending December, and we transfer that money up to January because that's what we're starting with. We can see during the month of January we had $1,000 in sales, so that brought us to $2,000 total for cash in. And cash going out totaled to about $800. So we ended the month of January with a cash balance of $1,200. Now we take that $1,200, and that's going to be our starting figure for February. We walk through the same process. We end February with $900. We take that $900 and take it up to March. And that's what we're going to start our month of March off with. Now we can see the change here at the bottom. When we get to the end of March, we actually ended negative $300, so we ended in the red by $300 because our expenses at $2,400 were more than the money that we were bringing in at $2,100. So unfortunately, we would start April in the hole at $300. Now guys, this is as far as lecture goes. I'll be ending with this slide. There's two more slides. One is a video coming up on the next slide, and then one additional slide after that. I'll go ahead and scroll through those, but as in terms of lecture material, we're going to end here. Now I do want you to make sure that you view this video on the introduction to the income statement. It'll have a lot of great information here for you.